Why are ETF distributions and capital gains taxed differently? Imagine you're at a busy marketplace where vendors sell different kinds of goods. Some sell fresh produce, some sell handmade crafts. Now, think of exchange-traded funds as a kind of shop that bundles many investments together. But here's the interesting part. The way you pay taxes on what you get from these shops can vary a lot. Let's find out why. First, understand that capital gains are the profits you make when you sell an investment for more than you paid. With ETFs, you only pay taxes on these gains when you decide to sell your shares. The fund itself doesn't usually pay taxes on gains until you sell. That's because ETFs are designed to be tax efficient. They use a special process called in-kind redemptions. This means when investors want to cash out, the ETF can give them securities instead of selling assets for cash. This way, the ETF avoids triggering taxable events inside the fund. Now, distributions are different. These are payments that the ETF makes to shareholders, which can include dividends from stocks or bonds, or capital gains realized from selling securities within the fund. When you receive these distributions, you pay taxes on them in the year they arrive. So, even if you don't sell your ETF shares, you might still owe taxes on these distributions. Why does this happen? It's because ETFs can swap securities with authorized participants without selling them on the open market. This process, called in-kind creation and redemption, helps the ETF avoid realizing gains that would be passed on to investors. So, the fund stays more tax efficient. But when the ETF does distribute gains or dividends, those are taxed just like regular income or capital gains, depending on what they are. For investors, this means holding ETFs can lead to fewer taxable events during the year. You only pay capital gains taxes when you sell your shares, and the rate depends on how long you've held them. If you keep your ETF shares for more than 1 year, you pay a lower long-term capital gains rate. If you sell sooner, it's taxed at your ordinary income rate. In short, ETFs are structured to minimize taxable events inside the fund through in-kind transactions. Distributions are taxed when received, but capital gains are only taxed when you sell your shares. This setup makes ETFs a popular choice for investors who want to manage their taxes more efficiently.